In 1980, McDonald's called Ray Dalio with a chicken problem that threatened to kill their biggest product launch in decades. The solution he created didn't just save the Chicken McNugget, it became the blueprint for building the world's largest hedge fund. Early 1980, McDonald's headquarters in Oak Brook, Illinois. The executive team is sitting in a conference room staring at a problem that could cost them millions of dollars. They're about to launch Chicken McNuggets nationwide. Test markets have been incredible. Consumers love them. The product is going to be huge. But there's a problem, a big one. Chicken prices are volatile, really volatile. In the past year alone, chicken prices have swung 30% in either direction. If McDonald's launches McNuggets at a fixed menu price and chicken costs spike, they'll lose money on every single nugget they sell, potentially tens of millions of dollars. They can't pass the cost increase to customers. The whole point is a consistent, affordable menu price, and they can't just absorb unlimited commodity risk. The profit margins aren't high enough, so they're stuck. Launch one of the most promising products in company history and gamble on chicken prices staying stable, or delay the launch and lose competitive advantage. Someone suggests calling this guy in Connecticut. Ray Dalio runs a small firm called Bridgewater Associates. He's been doing economic consulting, writing research reports about commodity markets and currency flows. Maybe he has an idea. Ray gets the call, flies to Chicago, sits down with the McDonald's team. They explain the situation. We need to lock in chicken costs without actually buying millions of pounds of chicken months in advance. We can't store it. We can't process it yet, but we need price certainty. Ray looks at the problem, and here's where his brain works differently than most financial consultants. He doesn't see a chicken problem. He sees a cash flow problem with a commodity price component, and cash flow problems can be hedged. He starts asking questions. Where does chicken price volatility actually come from? Feed costs, corn and soybeans. Those are traded commodities with futures markets. What about processing costs, labor, energy? What about supply and demand fluctuations, seasonal patterns in poultry production? Ray goes back to his office in Westport, spends weeks analyzing the chicken supply chain, breaks down every cost component, maps out which pieces are hedgeable through existing derivatives markets. And then he designs something that's never been done before, an integrated hedging strategy that locks in chicken costs by hedging the underlying feed commodities and creating synthetic forward contracts with poultry suppliers. McDonald's implements the strategy, launches Chicken McNuggets nationally. The product becomes one of the most successful fast food items in history, and chicken price volatility completely neutralized. McDonald's profit margins stay exactly where they projected them, regardless of what happens to spot chicken prices. That consultation changed everything for Bridgewater, because suddenly every major institution with commodity exposure wanted to talk to Ray Dalio. Okay, so I need to tell you about the McDonald's chicken nugget story because when I first learned about this, I honestly couldn't believe it. This is one of those moments where you realize that massive hedge funds don't start with some genius having an insight about the stock market. They start with someone solving a practical business problem that nobody else knew how to solve. And I've spent probably way too much time researching this because the standard version of the story, Ray helped McDonald's hedge chicken prices. Everyone was happy. The end, that version completely misses what actually happened here. What actually happened is that Ray Dalio took a fast food supply chain problem and turned it into the foundation for institutional risk management as we know it today. So let me take you back to late 1979, early 1980. McDonald's is at an interesting point in its history. They've dominated the hamburger market. The Big Mac is iconic, but they're looking for growth opportunities. How do you expand when you already own the burger category? You add new proteins, and the most obvious candidate is chicken. Now, McDonald's isn't the first fast food chain to think of this, but they have a specific problem. Their entire business model is built on consistency and efficiency. Every Big Mac tastes the same whether you buy it in New York or Lowe's, Angels, or Tokyo. Every menu item has to be profitable at a fixed price point that makes sense to consumers. That works great with beef. Beef prices are relatively stable. There's a massive liquid commodity market. McDonald's can predict costs months in advance, build that into their pricing. Done. Chicken is different. I spent time looking at historical chicken price data from the late 1970s, and honestly, it's all over the place. In 1978, chicken prices spiked by 30% in a single quarter. 1979, they crashed by 25%. This wasn't just normal volatility, this was chaos. Why? Because chicken pricing isn't just about chicken supply and demand, it's about feed costs. Chickens eat corn and soybeans. If there's a drought in the Midwest and corn prices spike, chicken production costs go up. If there's a bumper crop and corn prices crash, chicken costs fall. Then you've got seasonal patterns, chicken production varies throughout the year. Then there's processing capacity constraints, labor costs, energy prices for refrigeration and transportation. It's this incredibly complex system with tons of moving parts. And McDonald's is looking at this mess thinking, we want to launch Chicken McNuggets nationwide. We need to price them at something like $1.99 for a 6-piece. How do we make sure we're profitable at that price point regardless of what happens to chicken markets over the next year? This is where Ray Dalio enters the story. Bridgewater in 1980 is not what it is today. It's a small firm, maybe a dozen people. They do economic consulting. Ray writes these detailed research reports about currency markets, commodity flows, international trade patterns. He's built a reputation for understanding how different markets connect to each other. McDonald's somehow finds out about him. I've never been able to pin down exactly how the introduction happened, but someone at McDonald's knew someone who'd read Ray's commodity research and thought maybe this guy can help with our chicken problem. Ray flies out to meet with them, and here's what I love about this moment. Most financial consultants would have approached this as a pure hedging problem. Okay, you need to lock in chicken prices, let's find chicken futures contracts. Problem is, there wasn't a robust chicken futures market in 1980. The markets that did exist were illiquid, didn't have the contract sizes McDonald's needed, didn't extend far enough into the future. Ray approaches it completely differently. He doesn't ask how do we hedge chicken prices. He asks why do chicken prices move? What are the underlying drivers? And can we hedge those drivers instead of trying to hedge the end product? This is where his systematic thinking starts to show up. He breaks down the entire chicken supply chain, starts with live chickens. What determines the cost of raising a chicken? Feed, corn, and soybeans. Those are liquid commodity markets with deep futures contracts. You can absolutely hedge corn and soybean prices. What else? Processing costs, labor, energy, transportation. Some of those are hedgeable, some aren't, but you can estimate them with reasonable accuracy. What about supply and demand fluctuations? Seasonal patterns are predictable. You can model them. Unexpected supply shocks, disease outbreaks, extreme weather, those are harder, but you can buy insurance against catastrophic scenarios. Ray builds this integrated model. Instead of trying to hedge chicken directly, he hedges the component pieces. Corn futures, soybean futures, energy derivatives. Then he works with McDonald's poultry suppliers to create custom forward contracts. The suppliers agree to process and deliver chicken at a fixed price. They take on some margin risk, but Ray helps them hedge their own feed costs to reduce their exposure. The result is this beautifully elegant solution. McDonald's gets price certainty for their McNugget launch. The suppliers get predictable margins because their input costs are hedged. Everyone shares the risk in a rational way instead of one party gambling on commodity prices. McDonald's implements the strategy. January 1983, they launched Chicken McNuggets nationally, and the product is an instant phenomenon. We're talking one of the most successful fast food launches in history. By the end of 1983, McDonald's is selling hundreds of millions of McNuggets. The price stays stable. The margins stay exactly where they projected. The hedging strategy works perfectly. Now here's where the story gets really interesting for Bridgewater's evolution. Word spreads, and I mean really spreads, because think about who's paying attention. Every major corporation with commodity exposure. Food companies buying agricultural products, airlines buying fuel, manufacturing companies buying metals and energy. They all have the same fundamental problem McDonald's had. How do we run a business when our input costs are wildly unpredictable? And suddenly, there's this guy in Connecticut who solved it for McDonald's using creative derivative strategies. The phone starts ringing. Can you do for our oil exposure what you did for McDonald's chicken? Can you hedge our currency risk? Can you help us manage interest rate exposure? Bridgewater's business model transforms almost overnight. Ray goes from writing economic research reports to doing institutional risk management consulting. And this is critical because it's forcing him to develop systematic approaches to hedging and risk management. It's not enough to solve one chicken problem. He needs frameworks that work across different commodities, different time horizons, different risk profiles. This is where the seeds of pure alpha get planted. Because as Ray is building these hedging strategies for clients, he starts noticing something. the mispricing opportunities, the inefficiencies in how different markets relate to each other, the fact that you can often hedge risk and actually get paid to do it if you structure the trades correctly. Let me give you an example of what I mean. Let's say you're hedging corn exposure for a food company. You buy corn futures to lock in prices, but you notice that corn futures are trading at a discount to where you think they should be based on current supply and demand. So you're not just hedging, you're actually getting into a position that has positive expected value. Or you're hedging currency risk for a multinational corporation. You need to sell euros and buy dollars 6 months from now, but the forward exchange rate is mispriced relative to interest rate differentials between the US and Europe. So your hedge actually has an embedded profit opportunity. Ray starts systematically looking for these situations, where risk management creates return opportunities, where understanding how markets connect to each other allows you to both hedge risk and generate alpha. This becomes the core insight behind Pure Alpha, which launches in 1991. But it all traces back to that chicken nugget consultation, because that's where Ray learned how to take a complex real-world problem, break it down into component pieces, identify which pieces are hedgeable in existing markets, and create synthetic solutions for the pieces that aren't. Now let me tell you why this story matters beyond just being a cool piece of business history, because I think there's a deeper lesson here about how financial innovation actually happens. It doesn't happen in ivory towers with academics writing theoretical papers. It happens when someone with a practical problem needs a solution that doesn't exist yet, and someone smart enough figures out how to build it. Ray Dalio didn't set out to revolutionize institutional risk management. He set out to help McDonald's launch chicken nuggets without gambling on commodity prices. But in solving that specific, practical problem, he developed frameworks and approaches that turned out to be applicable to every other risk management situation. This is how Bridgewater's entire systematic approach evolved, not from grand theoretical insights about how markets should work, but from solving real problems for real clients and then systematizing those solutions. The McDonald's hedging strategy became a template, a model for how to think about any kind of price risk. And here's what I find fascinating. If you read Ray's Principles book, he talks constantly about learning from experience, about building systems from practical problem solving rather than abstract theorizing. The chicken nugget story is the perfect example of that philosophy in action. McDonald's had a problem, Ray solved it, then he systematized the solution, then he applied it to other problems, then he built a hedge fund around those systematic approaches. Fast forward to 1991, Pure Alpha launches. It's using sophisticated systematic strategies to trade across multiple asset classes: currency futures, interest rate derivatives, commodity positions, equity index futures. But at the core, it's still the same fundamental approach Ray developed for the McNugget hedge. Understand what drives prices, identify mispricing opportunities, use derivatives creatively to express views while managing risk. Pure Alpha goes on to become one of the most successful hedge funds in history. From 1991 through 2020, it averages roughly 12% annual returns. Through multiple crises, through completely different market regimes, the systematic approach keeps working. And you can draw a direct line from that success back to 1980 and the chicken problem, because that's where Ray learned how to think systematically about risk. That's where he developed the frameworks for breaking down complex problems. That's where he discovered that the real money in finance isn't in predicting prices. It's in understanding relationships between markets and finding opportunities where those relationships are mispriced. Let me bring this forward to today because I think this is relevant to how we should think about investing and risk management in 2025. The core insight from the McNugget story isn't about hedging chicken specifically. It's about systematic problem solving. It's about not accepting that risk is inevitable, but instead asking whether that risk can be broken down, understood, and managed. Think about your own investments or your business. What are the big risks you're exposed to? Market crashes, inflation, interest rate changes, currency fluctuations, whatever they are, the question isn't how do I avoid risk entirely. It's how do I understand what's driving that risk, and can I hedge the drivers even if I can't hedge the risk directly? That's the McNugget lesson. McDonald's couldn't hedge chicken prices directly in an efficient way, but they could hedge corn and soybeans and energy. They could create custom contracts with suppliers. They could break the problem into manageable pieces. You can do the same thing with investment risk. Can't predict whether stocks will go up or down? Fine. but you can diversify across asset classes that respond differently to different economic environments. Can't predict whether we'll have inflation or deflation? That's okay. You can own assets that protect you in both scenarios. This is why the all-weather portfolio exists. It's the same philosophy Ray applied to the chicken problem, applied to personal wealth management. You don't need to predict the future. You need to build a portfolio that can handle multiple futures. Now I want to address something because I know what some people are thinking. This is a nice story, but it was almost 45 years ago. Does it really matter today? And my answer is absolutely yes, it matters today. Because the fundamental approach Ray developed, systematic problem-solving, creative use of derivatives, understanding market relationships, that's still how Bridgewater operates. When Bridgewater positions for macro trends today, they're using the same framework Ray built solving the chicken problem. Break down complex systems into component parts. Identify what's predictable and what's not. Hedge the unpredictable parts. Express views on the parts where you have an edge. The tools have gotten more sophisticated. The markets are more complex. The computing power is exponentially greater, but the underlying philosophy is identical to what Ray used in 1980. And here's what I think is most remarkable about this whole story. The Chicken McNugget is now this iconic American food item. Billions sold every year. Most people eating them have no idea that their existence is partially due to Ray Dalio figuring out how to hedge corn futures. They just know they like chicken nuggets. That's kind of perfect, right? The best systematic solutions are invisible. They just work. McDonald's doesn't advertise that their McNuggets are possible because of sophisticated derivative strategies. Customers don't care about the hedging. They care that the nuggets taste good and cost the same every time. Same thing with Bridgewater's Pure Alpha Fund. Investors don't get a detailed breakdown of every hedge and every derivative position. They just see consistent returns through multiple market cycles. The systematic risk management is invisible. It just works. That's the legacy of the chicken nugget consultation. Not that Ray got famous for it. Most people don't even know this story. But that one practical problem in 1980 became the template for building the world's largest hedge fund. It taught Ray how to think systematically about risk. It showed him that financial innovation comes from solving real problems, not from abstract theory. And it demonstrated something that became a core Bridgewater principle. The best opportunities come from understanding things that other people think are too complicated or too mundane to be worth understanding. Everyone else saw a chicken supply chain problem. Ray saw a derivative solution and a business opportunity. Think about what that means for your own career or your own investments. The opportunities aren't always in the obvious places. They're not always in the sexy emerging technologies or the hot stock tips. Sometimes they're in the boring, practical problems that everyone else ignores because they seem too specific or too operational. Ray built a $150 billion hedge fund by being willing to think deeply about chicken prices. What practical problem could you solve that might lead somewhere unexpected? Let me wrap this up with one final thought. The McDonald's chicken nugget story is perfect because it's so absurd on the surface. Chicken nuggets and hedge funds seem like they have nothing to do with each other, but that's exactly why it's such a powerful example of how Ray thinks. He doesn't see financial markets as separate from the real world. He sees them as tools for solving real-world problems. The McNugget needed price certainty. Derivatives provided price certainty. Therefore, derivatives could save the McNugget. And in the process of saving the McNugget, Ray discovered frameworks that would work for every other risk management problem in finance. That's systematic thinking. That's what makes Bridgewater different. They didn't start with a theory about how markets work and then try to find applications. They started with practical problems and built theories from the solutions. So the next time you eat a chicken McNugget, and statistically most of you will at some point, remember that you're eating a financial innovation. You're tasting systematic risk management. You're experiencing the physical manifestation of the philosophy that built the world's largest hedge fund. And if that doesn't make you think differently about both McNuggets and hedge funds, I don't know what will. Now I want to hear from you. What's a practical problem in your business or your life that seems unsolvable? Have you tried breaking it down into component pieces the way Ray did with the chicken problem? Drop a comment below. If you found this valuable, hit that like button and subscribe. We're releasing new Ray Dalio deep dives regularly, exploring every moment and every principle that built Bridgewater into what it is today. I'm your host, this is legendary investor, Ray Dalio, and I'll see you in the next one.